Assalamu alaikum warahmatullahi wabarakatuh. Welcome to the Enterprise Design and Analysis tutorial, at the fourth meeting, Economic and Financial module. For the outline at this meeting, namely 1. Economic and financial aspects. 2. Fixed capital fund. 3. Working capital fund. 4. Capital structure. 5. MARR determination. 6. Break-even point. 7. Sensitivity analysis. After we learn about the market and marketing, technical and technology aspects, as well as operations management in a project, the next stage we will learn about the economic and financial aspects. If we are going to make a project, the project must be profitable. Besides the financial aspect, is also important to analyze whether the project we make, or the company we have founded is feasible or not. Therefore, it is necessary to learn more about economic and financial aspects. In the financial aspect, of course, companies need funds to run their business, so there are several groupings including fixed capital funds and working capital funds. For the first capital fund. For fixed capital funds, it means funds that include financing and procurement of pre-investment activities, or funds issued by the company for project development. Here are 5 types of fixed capital funds including 1. Pre-investment licensing, research study, and partner evaluation. 2. Procurement costs such as land, buildings, machinery and equipment as well as vehicles. 3. Cost for procurement of fixed capital and technology. 4. Loan interest costs during the period of project development. Example, paid if you make a debt or credit to finance the project. 5. Unexpected costs. Then for working capital funds. Here means funds that are directly related to activities that support the production process. For example, working capital funds have raw material costs, supporting material costs, semi-finished materials costs, finished goods costs, cash reserves, and finally there are accounts payable. For example, accounts payable here, if we are going to collaborate with the supplier, then we can make a debt for raw materials to the supplier first. Before we move to the next discussion, we must know what is the difference between capital and funds. So capital means a collection of money or items used as a basis for carrying out a job. Meanwhile, the fund itself is a basic requirement of every company to meet its long-term working capital needs. After we understand the costs that arise in the construction of a project, the next stage we must understand the capital structure. The capital structure consists of 2, namely, first, there is own capital, comes from the founder of the project. And secondly, there is loan capital, this loan capital comes from government bank credit. Both long-term and short-term, long-term credit from foreign financial institutions. Then here to calculate the capital structure we have to calculate the cost of the project in advance. The cost of this project is the sum of fixed capital and net working capital. And for the source of financing funds comes from the sum of the capital itself with a loan. Here, we must to know that, in calculating the capital structure, do not let the source of financing funds be less than cost of the project. Because if this happens, the project will not run due to lack of costs. After we know the capital structure, we will then discuss about MARR, minimum attractive rate of return, equal to internal rate of return and equal to return of investment. So the minimum return interest rate, where the interest rate will be used as a basis or indicator for management decisions in considering a business or investment feasibility. In the calculation of this financial module, it is taken from the previous module data, such as production capacity data, forecast data, market share data and other supporting data. In this financial module there are several related calculations, namely break-even point, minimum attractive rate of return, and sensitivity analysis. The relationship between these calculations is that the selling price will increase if the minimum attractive rate of return condition is normal, and the break-even point falls, or the minimum attractive rate of return condition goes up, and the break-even point is fixed. The selling price can be lowered if minimum attractive rate of return conditions are normal, and break-even increases, or minimum attractive rate of return conditions decrease, and break-even point remains. However, if minimum attractive rate of return and break-even point change simultaneously, the product selling price adjustment is relative, depending on the rate of increase or decrease in both. Then the sensitivity analysis relates to the selling price and sales volume. The following are methods used in determining the minimum attractive rate of return value. 1. The present value method, or present worth. The present value method is based on the concept of the equivalent value of all cash flows to the present value. The higher the minimum attractive rate of return used, the lower the p-value, as well as the farther the cash flow that occurs, the lower the p. 2. Uniform series method, or annual worth. The uniform series method is based on the concept of the equivalent value of all cash flows over the planning horizon, which is converted into a uniform series, A. The annual worth is also the same as the present word. 3. Future worth method. The future value method is based on the concept of the value equivalence of all cash flows to their future values. Future worth is also the same as the two previous methods. 4. Return rate method, or rate of return. The rate of return method is based on the occurrence of a balance between cash inflows and outflows. In cases there are a number of mutually exclusive alternatives. Alternative selection is carried out using the analysis of the incremental rate of return, with the following steps. 1. Calculate the rate of return of each alternative. 2. Compare the rate of return of each alternative with the minimum attractive rate of return, discard those alternatives. Rate of return less than minimum attractive rate of return. 3. Sort the alternatives by rate of return is greater than or equal to minimum attractive rate of return, starting from the smallest initial investment. 4. Calculate the incremental rate of return starting from the smallest investment with the next smallest investment. 5. If incremental rate of return is greater than or equal to minimum attractive rate of return, choose an alternative that requires more investment costs. Big. Conversely, if incremental rate of return less than minimum attractive rate of return, select an alternative that costs money, smaller investment. 6. Repeat step 5 until one alternative is selected. Payback period method. Payback period means determining the value of n so that p equal to 0, or f equal to 0 or equal to 0. Where the payback period is the number of periods n required to return cover the cost of investment with a certain rate of return. Formula. The investment plan is said to be feasible if the payback period n is less than or equal to estimated life. For this reason, it is necessary to predict the residual value if the asset is used before its economic age, yes equal or greater. The disadvantage of this method is that it does not consider the after cash flow. The benefit or cost method. BC ratio P, A, F, I, N. The BC ratio method is generally used to evaluate government projects. A project is said to be feasible if the ratio of benefits to costs required BC is greater than or equal to 1. B. All benefits, net of negative impacts, are stated in monetary value. C. All costs after deducting the amount of savings. Then we will discuss the break-even point value. Break-even. This point can be interpreted as a point or situation where the company in its operations does not gain a profit and does not experience a loss. This means that the company must sell its products at least reaching the break-even point so that it does not suffer losses. There are 4 components of BEP that must be known, namely: 1. Fixed costs are fixed costs even though the production volume changes. 2. Variable costs are costs that vary according to production volume. 3. Revenue is the profit or income received by the seller of goods. 4. Profit is the residual income after deducting fixed costs and variable costs. The break-even point formula has two ways. Break-even point unit. Fixed cost divided price per unit minus variable cost per unit. Break-even point rupiah. Fixed costs divided contribution margin per unit divided price per unit. The results of these calculations are to find out in a business will return on investment if it sells, or gets calculated results. After we know the costs that appear, the minimum attractive rate of return value, and the break-even point. The next step is to conduct a sensitivity analysis. Sensitivity analysis is used to determine how sensitive a decision is to changes in the parameters that affect it. The trick is to change the parameter value at a time to see how it affects the acceptability of an investment alternative. The parameters in the sensitivity analysis can vary, and the changes can affect several decisions including investment costs, cash flow, residual value, interest rates, tax rates, etc. For more details, the implications of this sensitivity analysis can be seen in the video software session. Thank you for your attention to this tutorial. Hopefully the knowledge we have learned can be useful. If there is an error, we apologize. Wassalamualaikum warahmatullahi wabarakatuh.